Welcome to Profit and Prosper, a podcast for entrepreneurs who are ready to make some money while doing what they love. On this podcast, we're going to pull back the curtain and talk about all things business and money. But I promise you, this is not your typical boring numbers talk. I'm your host, Sarah Young, a CPA and CFO with over a decade of experience in finance, business, and leadership. I'm going to share everything I've learned from helping my clients grow more profitable businesses and keep more of what they earn while growing my own successful business along the way. You'll feel empowered and confident that you too can grow your wealth, live a rich life, and have an impact. Stick with me and you might even start to think that finance is fun. Let's dive in. Welcome back to this week's episode, y'all. We're going to talk about taxes. And I think in 6 months of doing this podcast, I may have had one other standalone episode on taxes. And there's a reason for that. I feel like I could potentially get ranty with this episode, but ultimately, I think that a lot of the information out there that you find on Instagram and TikTok and anywhere you're reading on the internet about taxes, I think a lot of it is designed to be clickbait because people know that you hate paying tax. I don't like paying taxes. Everybody hates paying taxes, right? Like it sucks. I totally understand that it sucks. And a lot of people think that there is some guru answer to not paying taxes because we also read these news articles that talk about billionaires not paying much in taxes, right? And so you think that, well, if they can do it, what do I need to do to be able to do that? And we'll talk about that in this episode. But the reason I don't spend a ton of time talking about taxes is because I think there's a lot of nuance around all of the tax strategies that I'm going to talk about in this episode that I cannot possibly cover in a podcast episode. Okay, so as you're listening to this, please understand, as you're seeing anybody else talk about anything related to saving money on taxes, please understand there's a lot of nuance around, will this apply to your situation? Is this the best choice for your situation? And exactly how do you get it right? Okay, so know that going in, and I will do my best to make sure I don't imply that, every one of these tax strategies is right for you, because they're not. At the same time, I know that a lot of you work with the traditional tax prep company or firm that maybe they don't spend a ton of time actually educating you on these tax strategies. And I actually had somebody several weeks ago say to me, Sarah, I learn more about taxes and my business's finance from your free content than I ever have from my tax person. And I laughed because it's true, because a lot of them just don't have the time or take the time to educate you on these things because they're going for the lower cost tax prep service. Okay, not going to get ranty. Here's what we're going to talk about. We will cover 10 of my favorite tax strategies that I use with my clients to help them save money on their tax bill. We'll talk about why you usually have to spend money to save on taxes, my rules and mindset and approach to taxes and why that's different from the people who have the clickbait out on the internet, and why I'm skeptical, right, about people on the internet talking about tax strategies, which I already kind of touched on already. So let's actually start off with my approach to taxes. And I think after I go through these, it will be clear why I'm skeptical of the people on the internet who promise you, if you do this, you're going to save on taxes. Okay, my tax rule number 1 is this. If you make money, you are going to have a tax bill. So if your business is profitable, you are most likely going to have taxable income, which means you will have some level of a tax bill. And here's the thing. I believe that taxes, while it does suck to pay taxes, and as a business owner, you're not having them withheld from a paycheck. And so you feel it more when you have to pay $1,000+ to the IRS every quarter, right? But I don't believe that inherently taxes are bad. But people always ask me, well, why do the billionaires not pay taxes? Number one, you're reading these articles because, again, they are clickbait, and the media companies know that you're going to click on that to see, well, what are the rich people doing? And there's a lot of things that they can do that take advantage of things in the tax code that allow them to take these deductions, some of which include a lot of the times billionaires aren't paying taxes because they have income in one year, but in a prior year, they had a huge loss in their business. And when you have a loss, you get to carry that forward and offset future income. This is called the net operating loss deduction. Fun fact, you can take advantage of this too. But to take advantage of it, you have to have a loss, which means you lost money in a prior year. Okay? So that's a big one that we see a lot. There's also, yes, with these huge corporations, there tend to be complex tax structures. They probably have some foreign income. All of these things, yes, they are real things, but they're more complicated than what the average person really needs to deal with. When you become a multi-millionaire, maybe we can talk about it, okay? But for most of you listening to this, this is just not something you even need to think about right now. A lot of people also stress about if I make more money in my business, then I'm going to be in a higher tax bracket and they're going to take more. Yes, you will pay a fraction more on that bracket of income, but that doesn't mean that you're not going to net more money, right? So the highest federal tax bracket is 37%. That doesn't mean that when you kick up into the 37% bracket, all of your income gets taxed at 37%. It's just that top portion. And I don't know about you, but I would rather keep 63% of millions of dollars than not have the millions of dollars in the first place. That's just me, okay? Rule number 2 is I think taxes should not be your primary focus. I see a lot of people, coming from not the clickbaity place, but just out there educating on tax deductions in detail. And I think that's great, totally become more financially literate. But I also think that most of the people I work with don't necessarily want to learn the nuances of the tax code, and nor should you. I think your focus is much better used on doing what you do and making more money instead of focusing on this or that tax deduction, right? Profitability overall needs to be your focus. Overall, how do we make more money? Taxes are just a piece of that equation. They're not the primary focus. Also, never buy something just for the tax deduction. So if you buy something in your business, yes, you get a write-off, but that means you're buying something, yes, technically at a discount, right? If I spend $10,000 in my business, sure, I might get $2,000 to $3,000 in tax savings, but that still means I spent $6,000 or $7,000 or $8,000, right, out of pocket. And so if you can't afford it in the first place, just like going to the store and buying something with a coupon, don't buy it, okay? Don't buy anything just for the tax deduction. The third rule that I have is, we've kind of touched on it a little bit, but I think it's hire help. So if taxes are not your primary focus, when you are generating enough money from your business to pay yourself a salary to cover your bills and then have some buffer left over, I think it is time for you to hire help in this area if you haven't done so already. And when I say hire help, I really mean somebody who will sit down and talk through a tax plan and a tax strategy with you and not just do your return. Because when you have that level of money, you will have some wiggle money to save on taxes if you are strategic about it. And so generally my threshold for our tax service is it's ideal for people who are starting off with at least 50 to 75K in profit from their business, bottom line profit. That is because when you have that, you're usually able to pay all your bills, and then you have extra cash that we can help you allocate and think about the tax pros and cons of each decision, right? So hire help because it's going to save you more time and effort and money than trying to figure this shit out on your own. If you're enjoying my podcast, then you are going to love my exclusive weekly email series, Profit and Prosper Millionaire Mondays. As a business owner, you have limitless potential for the amount of cash flow you can create in your business, but your journey to building wealth might not feel all that straightforward. To convert your cash flow into real wealth, you need to do a bit of planning and strategizing so that you can be wealthy and be well, reaching financial independence and eventually retiring or relaxing early at your lake house, which is my plan. In my Millionaire Mondays email series, I share tactics and strategies for using your business to generate your first $1 million in net worth in the same approachable way that you get in the podcast. Sign up for my exclusive emails for free at profitandprosper.co/millionaire. My goal is just to get you thinking about some things that you might be able to use in your business, and then you can go and talk to your tax person about these things. So let's talk about tax strategies. And I actually have put these strategies into two buckets. So we have one bucket of strategies that don't require you to spend money, and one bucket of strategies that do require you to spend money. And so what I mean by that is, I think I said this already, but most tax strategies, most of the time when you want to save on taxes, you have to spend money. And that is because the tax code is written as an incentive system. When the government gives people a deduction, a write-off opportunity, it is because they want to incentivize you to do that thing. So the reason that there are deductions for business expenses is because they want to incentivize you to have a business because it stimulates the economy. Why there are deductions for retirement contributions is because they want to incentivize you to save up for your retirement. And so most of the time, these things require spending money. So let's talk about the first handful of strategies to save on taxes that do not require spending. Number one is have freaking clean books, y'all. If you do not have clean financials for your business, you are going to miss out on deductions, or you are going to somehow duplicate your income. I actually had a tax client come on a couple months ago where I looked at her QuickBooks and her revenue was double counted for the entire year of 2021. And that was like 75, maybe all of her revenue wasn't duplicated, but it was like 75K too high. And if I hadn't taken the time to actually go through and look at why it was messed up, she would have paid tax on $75,000 of additional income, y'all. Also, when people mix up their business and personal stuff, it is difficult. So actually a couple of months ago, I paid an invoice and I pulled up my 1Password to put in my credit card, and I clicked on my personal card instead of the business card. And had I not immediately made a note of that and then put it into my QuickBooks manually, I would have forgotten that I spent $1,000 on this invoice, and then I would not have been able to take the deduction, right? So keep clean books is strategy number one. Super easy. Anybody should be able to do this, okay? Strategy number two is just to take advantage of the deductions that you are already entitled to. I think anybody can do this at any income level from the time you start your business. I'm going to tell you a couple of the things that I find commonly missed on tax returns when I'm reviewing a new client's prior year returns. These are things that people are afraid to take because they're thinking oh, if I mess it up, they're going to come arrest me, or they're going to send me all these penalties and fines, or people tend to be really conservative. And so they don't take these things. I'm here to tell you these ones I'm going to list out are completely valid. And if you need help implementing them, reach out to your tax person, okay? Commonly missed deductions are your home office expense. So you are already paying your rent or mortgage, your utilities, your internet, any home repairs, things like that. Why not take the deduction for the part you use for your business, right? Home office deduction is one commonly missed. Your car expense or mileage. I'm not going to talk yet about buying a car in your business, but if you're driving anywhere for business, track it. Take the mileage deduction. You're already paying for the gas and the use of your car personally, so you get to take a portion of that and put it against your business if you're using it for business. Health insurance is another one. So if you're self-employed and you are paying for your own health insurance, again, nuance around health insurance, please know that. But generally, if you don't have a spouse and you're on their plan, and you're paying for your own health insurance or your family's health insurance, then you can take that as a deduction in your business, but the structure is important, okay? The other commonly missed one is cell phone. Like, y'all, I pay easily for the cost of my phone and the phone bill, probably at least $1,000 in a year. And so I will go back and I ask my clients this every year, send me, what did you pay for your cell phone and what percent did you use it for business? Probably not 100%, but you're doing things like taking calls, answering emails, posting on social media, having your to-do list, whatever. You're running your business from your phone. Like, take a portion of that, whatever a reasonable percent is, and put it as a business deduction. You don't have to spend any more money than you have already spent to take these deductions, so why not take advantage of them? Strategy number 3, this is going to be an intermediate one, all right, y'all? The first 2 were beginner level. This one is intermediate. S-corp elections. Okay, here's what I'll say. I have seen a lot of brand new business owners who, at their accountant's advice, make an S-corp election in year 1 of their business. And I think for most people, this is a giant mistake. The S-corp election is helpful for you when you are probably making a minimum threshold of about $75,000 in profit, bottom line profit, or more. And even at $75K in profit, your tax savings, most of those are going to be offset by the administrative cost of a separate S-corp tax return and having to run payroll, okay? So, and I will say, I have seen clients who have S-corps and then in years where they have a loss in their business, your S-corp actually can cost you money because of the nuances, again, the nuance around qualified business income deductions and all of these things. So let me back up for a second. The S-corp election is a tax election. It is not a legal entity type. You can do this if you have an LLC or a C-corp. Most of you probably have an LLC. And it's literally where you file a form and say, I want to be an S-corp. And the IRS says, cool. So let's use an example. If you have $100,000 in profit, you will save money by being an S-corp because you are going to take a portion of that profit and pay yourself a W-2 salary. So you are going to become an employee of your business, which means you need to be on payroll. I generally tell people to go get Gusto and set themselves up on payroll, and you don't have to worry about any of the payroll tax forms, just paying Gusto and running your payroll, okay? So let's say you choose to pay yourself a $50,000 salary. On that salary, you are going to have, as an employee, federal income tax withholdings, state income tax withholdings, and the payroll tax. So just like if you're employed anywhere else, you have the Social Security and Medicare taxes withheld. And the employer, in this case, also you have to pay the other side of that payroll tax, right? So there's really no change on that salary piece from what you have if you just have a plain old LLC, where with the plain old LLC, you pay all of those taxes on the 100K. Right? With an S-corp, you pay all of those taxes on the salary piece, the 50K. On the profit left over, after you pay yourself a salary, so in this case, 50K salary, 50K profit, on that $50,000 in profit, you are not going to pay the payroll tax, which is about 15% of your income. And so what is that? $7,500 in payroll tax on that 50K, right? And that's why people like S-corp elections. Now, here's the nuance. I don't want to go too deep into this, but there is a qualified business income deduction of 20% on your business income. So as an LLC, if you have 100K in profit, generally speaking, rough math, you'll get a $20,000 tax deduction. With an S-corp, you only get the 20% deduction on the 50K profit left over. And so you're cutting your deduction in half. And so that's why there has to be a balance of how much profit you make and how much you pay yourself, because you're going to lose that income deduction on your salary piece, okay? The other thing is there are some states that when you make the switch from being an LLC to an S-corp, they impose additional franchise and excise taxes on you. For example, one of those states is Tennessee. There's no income tax in Tennessee, but if you have an S-corp or C-corp, generally speaking, you are going to pay a franchise and excise tax of about 6%, I think. And so obviously that extra state tax on your S-corp income is another offset and raises the income threshold for where it is advantageous for you to have an S-corp. So when it comes to S-corps, here's my rule. Do it when you have consistently and you're confident in your cash flow, where you're going to have at least $75,000 in bottom line profit, meaning sales minus business expenses or more, and then you're good to do an S-corp election. Okay, so that's tax strategy number 3. Nothing really to spend there. It's just an election and a slightly different structure. You do have a separate business tax return and you have to do payroll taxes. So there's some additional cost, but again, overall, for the right people, you're going to save literally thousands in taxes. Let's move on to tax strategy number 4. So this one is the Augusta Rule. This one is another one you don't have to really spend any more money to get the deduction. So the Augusta Rule is named after the home of the Masters tournament. I think it's the Masters tournament. My husband loves golf. I think if I say this wrong, he might be embarrassed. I think it's the Masters tournament. Anyways, the Augusta Rule says if you rent out your home for less than 2 weeks out of the year, you don't have to report the income. And this is because at the Masters tournament, all the people in Augusta, they want to rent out their home because people pay bukus of money to come and watch the Masters tournament. Business owners can take advantage of this by renting out your personal home to your business to do things like having a quarterly CEO shareholder meeting, right? This is actually a valid thing. Even if you're the only like person in your business, you still have to have at least quarterly, or you should be having at least quarterly meetings where you're doing planning and strategy for your business. And so I like to use this if people rent a separate office space for their business, because if you have a home office already and you're already in your home every day and you're taking the home office deduction, I think it's sketchy to also do the Augusta Rule. But like me, I have a separate office space. You can see behind me if you're watching the YouTube version. So I will take advantage of the Augusta Rule by saying I'm going to rent out my house to myself for my quarterly shareholder meeting. And to do this, I document it, right? I have to do an invoice. I have to make sure it's rented out at a comparable rate to what I could get at like a hotel or something around here. But I can rent it to myself. And because I'm renting it to myself, or not to myself, but to my business for less than 2 weeks, I don't have to report that income as rental income. The last strategy that doesn't require additional spending is the timing of your cash flow. So to explain this one, I'm going to give you an example from one of my clients. I had a client come in January of this year where they have a like subcontractor model, meaning they have, like millions of dollars coming in revenue, but they're only keeping like 75% of that. So they have all the revenue coming in and then they pay it out to their subcontractors later. They came in January of 2022. And so I really didn't have time. I had no time to talk to them about timing because it was after the fact, but they ended up having a very high taxable income in 2021 because they had a lot of big sales in December 2021. And then they didn't pay the subcontractors until January. And so what happened was, because when you pay taxes, you're doing cash basis most of the time, which means you pay tax on the income when it's received and you get to take the expenses when they're paid. And so in this case, for their 2021 tax return, we had to report that income because it was cash paid and they hadn't paid the subcontractors until January or February. Had I come in 6 months earlier, which is usually my preference, I would have talked to them about the timing of that cash flow, because what happened was they had a big tax bill for 2021. And then in 2022, because they had a very large expense in January, February, they've not had to pay estimates yet for 2022. So maybe that's nice for 2022, but overall it's kind of crappy when your income fluctuates that much. So when you're looking at year over year, you can time your cash flows according to do you need to raise or lower your income to, for example, if you're in the 35% tax bracket, the next lowest one is 24%. That's a big jump. Is there any way you can time your sales receipts or paying your expenses to get you into that lower tax bracket for a taxable year? That's when it's helpful to time your cash flow, right? Because in this example, that I gave, let's say if that big cash influx put them into the 35% bracket for 2021, but then they ended up being, let's say, in the 12% bracket in 2022, that's a big tax difference that we potentially could have avoided by planning appropriately. So those are the strategies that don't require any additional spending on your part. Here are 4 more tax strategies that do require you to spend money in order to get the tax savings. First, buying a car or equipment for your business that is financed. First off, don't come at me asking me if you work from home in your office and you never leave and never drive anywhere, can you buy a car? The answer is no, you can't buy a car and write it off. If you are like the clients I have that are interior designers, home organizers, wedding planners, stuff like that, where you are out, landscapers, whatever, where you are out driving around all the time, yes, you can buy a car and write it off in your business as a legitimate expense. So the reason that the financing piece is important is because it enables you to take the write-off for the expensive equipment you're buying, but not actually have to pay for it yet. So let me give you an example. Let's say you buy a car for your business and it costs $50,000. And there's, again, a lot of nuance around weight limits and usage of the car that matters, but let's assume that it qualifies to be expensed all in year 1. There are a couple of depreciation rules that allow that to happen. One is bonus depreciation. The other is Section 179 depreciation. Again, you don't need to learn about this. Just go hire somebody to help you. Let's just assume, for simplicity's sake, that you buy a car for $50K and it qualifies to be fully depreciated in year 1. But you bought that car or truck or whatever and you financed it, meaning you took out a loan. So you probably put in a down payment of $5 to $10K, right? But you got a write-off of $50K. So the write-off saved you, let's say, $10,000 to $15,000 in taxes because you got that write-off, but you didn't actually have to pay the cash, the full $50K, because you're financing it over the course of many years. And so this one is amazing if you have a high income in a given tax year. I'll give you an example. Another piece of equipment. My husband and I have talked about buying an ice machine, a vending machine, a laundromat, like something where we're buying equipment and then we don't have to run it and people just pay to use it, right? Passive income. If we buy this ice machine or vending machine for $50,000, then we finance it, right? We can put like $5,000 down. I will make money in my business this year. Like I will have profit. And if I can take that $50,000 ice machine, the depreciation on that can offset my other actively held income in my business, then that means that collectively on our personal taxes, we will literally save $10,000 to $15,000 in cash that I would have had to take out of my business and give to the IRS. But I don't have to take that $15K and put it down for the equipment because I've financed it, and so I'm going to pay it over time. And I'm going to structure it so that it cash flows, meaning the money that I make off of the equipment is going to more than pay for the ongoing loan payments and the maintenance and all of that, right? So like this one is genius, but it is the most beneficial if you have income. Because if all I had coming from my business was, let's say, so the standard deduction is like $24,000 for a married couple. If I only had $20,000 of taxable income for my business, that's less than the deduction, meaning we're not paying taxes, meaning I'm not going to be able to take advantage of that write-off this year. So this is a good way if you need to buy equipment or you need to buy a car. Again, one of my rules was don't buy something only for the tax deduction, please. But if you do need one or you want to invest in one to create another stream of income for yourself, that is an amazing tax write-off, right? That can create real cash flow, right? 10 to 15K that I would not have had to take out of my business to pay the IRS, I can then take out and deploy somewhere else or use it to buy the equipment. Next tax strategy is retirement contributions. So one of the things we talk about with our tax clients is they generally have buffer cash sitting there. Because like I've said, the ideal client for our tax service, we can do strategies is you're paying yourself enough to live off of, and you have some buffer that we can help you strategize on what to do with. And so if you want to make retirement contributions, a lot of retirement contributions you can get a deduction for this year, right? So again, they want to incentivize you to save for retirement by giving you a tax write-off. And so a retirement contribution, the ones I start with, I've said this in previous episodes, we like to start with traditional or Roth IRAs, HSAs, as they're super easy. Most people can do those, many people. And then we have self-employed retirement plans and your spouses, if you're married, making sure they're taking advantage of their retirement plans, etc., right? This is where it is helpful to have some idea of your overall wealth strategy, which is why I talked about that, I think, back in episode 20 through 25, right? Because it'll help us say, well, if your goal is to put this much money in your retirement accounts, let's do this much this year, and this is the tax impact. Now, I like to focus on taking pre-tax retirement contributions when you have a high income. And so the two types of retirement contributions are traditional, meaning pre-tax. So you get a write-off this year if you make the contribution. This is like your traditional 401k, the traditional IRA, you get the deduction now. I like this when you have a high income, like especially when you're in the 35% tax bracket or higher, or maybe some people who are in the 22-24% bracket, but they're in a high income tax state. I like to do pre-tax contributions. If you are in the 10, 12, 22% tax bracket, 24% even, when your income is generally like 150K or less, I like to encourage Roth contributions, meaning you don't actually get the tax benefits of that this year, but that doesn't impact you that much because you're already in a relatively low tax bracket. And you put the money in, you don't get any tax advantages now, but when you take the money out later, it is tax-free, including any earnings on that money, right? And so think about retirement contributions. Don't always default to doing the pre-tax contributions when you have a low income because, it's just not always going to be the most advantageous for you. This is why I say, please get help if you have the money to do these things, okay? The next strategy, we're in the last couple, the next strategy is hiring your kids. People love to think about hiring their kids in their business, and I actually love it too. I plan to do it as soon as I can, but you have to realize, yes, you can hire your kids and pay them. You can get a tax break for what you pay them, but here's the thing. They need to actually do work for you. So you can't just pay them just because you can. Similarly, you can't just employ your spouse and pay them money. You need to actually have them doing work, right? What can your kids do that you can actually pay them for? And this has to be, you have to give them reasonable compensation. I can't pay my 2-year-old $10,000 for, coming and sitting in my office one day when I don't have childcare. That's not reasonable in any way. When they're older and they can do things like, clean your office, do some administrative work. My husband doesn't love this, but I joke we can take pictures of our 2-year-old and he can, be in our marketing campaign and I can pay him as a model. We don't do that, but it could be seen depending on the type of business you have. You could have your kid be a model for you. I know people who have kids clothing brands. You could have your kids model and you can pay them for that. You need to actually pay your kid to do the work, which means you're not going to get to keep that money. So this is good when you have the extra. But I'm going to tell you something next level that I have planned for my child. That is when he is able to work and earn money, because the standard deduction is currently, anyways, about $12,000 for an individual, any income he makes up to $12,000 will not be taxed for federal income tax. And because he has earned income, we can put money into a Roth IRA. So you can put $6,000 into a Roth IRA for him. And so you didn't pay taxes on the money up front, right? Because he was under the deduction limit. Then with a Roth, you don't pay taxes when you take the money out. So literally this money is never, ever taxed. And when I think about teaching your kids about how to invest, leaving them a legacy, like setting them up for success in life. Like imagine if I'm able to put $6,000 into a Roth IRA every year for like 10 years for him, like how much better off, like when, by the time he retires, I mean, I haven't done the math on how much money, but this would be hundreds of thousands of dollars, right? So this can be amazing. And as the business owner, you get the write-off. And so you don't pay taxes on the money either because you took the business expense deduction. Okay. So the last one I want to talk about, we've mentioned retirement contributions, but the last one is just general investments, right? So let's talk about real estate is the next investment that people make when they've kind of done all these other tax strategies. Real estate can be a really good, I don't want to use the word tax shelter because I think that sounds sketchy. But similarly to how I explained with the car, if you finance the car, you get to still take depreciation on the car itself, and then you save money. If you structure a rental property, or maybe you buy an office building or something like that, if you structure it the right way, then you finance the purchase of the real estate. What you do is you think, well, what do I need to rent this real estate for to cash flow? Meaning after I pay the loan, after I pay all the maintenance and all that other mess, the utilities, whatever you have to pay, I'm still making money. And so you're earning income from the real estate. But with real estate, you get a depreciation deduction on the real estate over 27.5 years, to be specific, if it's residential rental property. So you get to take the portion of the purchase price from the real estate and depreciate it over time, which means even if you are cash flowing from the real estate, like you're actually getting cash in your pocket, many times you will have little to no income to report on your tax return from the rental because of depreciation. It's important to think about strategically when you have money to invest. If you want to do this, talk about plan out what is the impact going to be on my taxes, right? So you can generate income for yourself and not have to pay taxes along the way. Now, when you go to sell the real estate, yes, you will pay taxes on the gains. But if you have excess cash sitting around and you want to invest it, please know this is a good way to earn actual money without necessarily having to pay taxes along the way. Here's what I'll wrap up with. Sometimes the things that are in your best interest aren't necessarily tax deductible, and that is okay. So as we've been talking about in this wealth series, some of you need to work on paying off debt. Some of you need to work on building up your savings accounts and your cash reserves, right? Doing neither of those things is tax deductible, unfortunately, but it's still in your best interest. And so as you generate income from your business, hopefully you have enough to pay your bills. And then if you need to do things like pay off debt or save money that you don't get the write-off for, I understand. You need to do this because it's in your best interest anyways. But then once you get to that next level, there are tons of tax strategies you can take advantage of. And some even the ones that don't require you spending money that I gave you, you could totally implement while you're also paying down debt and building up your savings. Okay. So hopefully out of all of this, you got at least one idea of potentially something you could use in your business, whether that's this year or sometime in the next few years that you can talk to your tax person about. Or if you really want to go learn about it, go for it. But just think about what's one thing that you heard that you can implement and what do you need to focus on? And I'm going to end with, if you need help with your taxes, if you're in a business, you're running a business and you're making money and you keep ending up with huge tax bills, or you're just not getting the support you need to, handle your taxes overall, you're not getting the support on just finance in general, send me a DM on Instagram or go check out our concierge tax service for business owners because it is an amazing service. I think so anyways. My clients tend to think so, to help you not just with your tax prep, but also tax planning and tax strategy. And every time I have a one-on-one with clients, we focus on how are you going to allocate your money? How can we allocate this to save you in taxes? What are your cash priorities? How much should you pay yourself? All those really common questions that are difficult to answer. Okay, that's what we are there to help with. So go to trustyoungco.com /concierge. The link will be in the show notes, or you can just DM me on Instagram. I will reply back to you and answer your questions, and we can have a consult, see if that's a good fit for you. Until next time, see you later. Thanks for listening to this week's episode. Now, I want you to go take some action. What's one thing you can do this week to create more profit in your business? Send me a DM on Instagram at YoungCoCFO and share your action item with me. If you have a question or topic you'd like me to dive into, or if you're feeling empowered about taking charge of your finances, let's continue the conversation. Go to profitandprosper.co to submit a question or topic for me to talk about on the show. And because we all profit and prosper better with friends, please leave me a review on Apple Podcasts, subscribe wherever you listen, and share the episode. Make sure you tag me at YoungCoCFO on Instagram so I can give you some love, and I'll see you in the next episode.